What I have for you today is not the usual case law, but I'm looking at Article 12A and B of the 2021 UN Model Convention. 12A concerns fees for services and 12B digital services. Let's have a look at what these articles say. 12A, fees for technical services. Fees for technical services arising in a contracting state and paid to a resident of the other contracting state may be taxed in that other state. That's obvious because the resident state can always tax. However, paragraph 2, notwithstanding provisions of Article 14 and subject to the provision of 8, 16 and 17, which deals with shipping and directors and artistes, and 14 for a fixed base, which we still have in the UN Convention. Fees for technical services arising in a contracting state may also be taxed in the contracting state in which they arise. So the source state may tax as well, according to the laws of the state. But if the beneficial owner of the fees is the resident of the other contracting state, the tax so charged shall not exceed X%. And for the UN model, the countries can typically pick what kind of interest or what kind of rate they want to apply, and the last part of the sentence, of the gross amount of the fees. So 12A covers fees for technical services. 12B covers income from automated digital services, and it reads pretty much the same. Income of automated digital services can be taxed in the resident state, says paragraph 1, and paragraph 2 says, however, subject to the provisions of Article 8, and notwithstanding 14, income from automated digital services may also be taxed in the source state, and the tax so charged shall not exceed the agreed percentage. So these articles look very similar, except that Article 12B does not refer to 16 and 17, and that's because it's unlikely that artists or directors would be providing automated digital services. It does, however, refer to the relationship between Article 12A and 12B, and it says in paragraph 7, the provisions of this article on automated digital services shall not apply if the payments underlying the income from automated digital services qualify as royalties under Article 12 or fees for technical services under Article 12A. And what the commentaries say is, you know, when you've got a compound payment, you may have to split this payment into its component parts, so you can apply the royalty rate for the component consisting of royalties, and income from automated digital services rate for the other. And the UN also says, you know, countries may simplify the application and execution of these articles by using the same rates across the board, which seems to be like a very useful advice. A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses. And if we then look at what technical services are, because these two articles deal with two different things, right? Then paragraph 3 defines technical services as any payment in consideration for any service of a managerial, technical, or consultancy nature, unless the payment is made to an employee or it is done in connection with teaching in an educational institution, or it is paid by an individual for services for individual use. So technical services, you can levy the withholding tax, and technical services covers all payments except between employers and employees. Educational institutions, where they say countries simply need to define what is an educational institution. Is it only university, or is it also colleges and things like that? And then individuals do not have a withholding tax liability, because that would be very difficult to administer. What is interesting is, if you look at the commentary to this article, technical services clearly refers to using some expertise. So the UN says that the withholding tax does not apply for routine services. And then they give quite a large number of examples of what are routine services and what are not, right? But basically you need, it is not the same definition as in transfer pricing, for example, but you do need some kind of specialization. If a service provided by a doctor, for instance, would be specialized services. It is not clear whether services provided by a nurse, especially a low-skilled nurse, would, for instance, qualify as services, right? And then we come to income from automated digital services, and it's important to remember that this has been added in April 2021. Right? So the UN has decided to keep this text in spite of Pillar 1. And there are also countries which may not follow Pillar 1. I believe that Kenya, I've been told, is a country which will simply says, you know, we will use national law, we will use the UN model, we're not going to apply Pillar 1. And for those countries, this article could be helpful, right? Because it says the term automated digital services as used in this article means any service provided on the internet or any other electronic network, in either case requiring minimal human involvement from the service provider. And the commentaries to this article describe what minimum human involvement is, and it typically the UN ties it with scalability, right? If you can sell to more individuals or more companies or whatever without doing a lot more work, then that probably requires minimum human involvement. If it still requires a lot of human work, or if it's specified for one particular case, then it does not require minimum human involvement, and it's not covered by the article. It also means, the UN explains, that, for instance, you know, developing a website or a service or something may require significant human involvement. But that is not what the article covers. The article covers once you're done with your product and you can sell, whether you sell 100 or whether you sell 1,000, it doesn't matter. You don't need a lot more human involvement. That is what minimum human involvement is. And then paragraph 6 defines or gives examples of automated digital services. It says includes. It does not mean that this is the only things, but these are primarily the examples, right? So online advertising services, supply of user data, online search machines, online intermediation platforms, social media, digital content, online gaming, cloud computing, and standardized online teaching services. And if this list sounds familiar, it is because it is the same as what comes from the Pillar 1 document from the OECD from 2020, where they gave the outline for, or the blueprint for Pillar 1 and Pillar 2, and paragraph 44, as you can see here, says, as noted, the above approach to the automated digital services starts with the proposition that if any activity is on the positive list, it is an ADS. The positive list currently contains the following 9 categories, and then it lists online advertising, sales, online search terms, etc., etc. Funnily enough, the cloud computing is different from is swapped around with number H and I in the UN list. I'm not quite sure what the reason for that is. And then the UN comes with a different alternative for Article 12b, in other words, only for automated digital services, where it says, you know, some countries are concerned that the taxation of digital services on gross income might be too high. Now, we do 2 things. One is we recommend that countries do not levy a withholding tax of more than 3 to 4% on automated digital services. And the second one is, if that is still too high, then companies can apply for being taxed on their net income. And this is what 12b(3) does. It says the provision of paragraph 2, in other words, gross taxation, shall not apply if the beneficial owner requests the other contracting state to subject its qualified profits to the taxation at the tax rate provided for in the domestic laws of that state, right? The qualified profit shall be 30% of the amount resulting from applying the profitability ratio of that beneficial owner's automated digital services business segment to the gross annual revenue from the automated digital services derived from the contracting state where such income arises. So let's say that your business segment has a profitability of 21%, right, globally. Then what this paragraph says is you then need to apply 7% of that as being arising in the other contracting state, and that contracting state can then tax that income according to its domestic laws, right? In other words, the net income. The commentary note, however, that it doesn't say that it must be taxed on a net income basis, but it assumes that in most cases, most domestic laws do tax income on a net basis, not a gross basis. And then it goes on to say, where the beneficial owner belongs to a multinational group, the profitability ratio shall be that of the business segment of the group, provided that such profitability ratio is higher than the aforesaid profitability ratio of the beneficial owner. So here's a piece of anti-abuse text, because the UN is afraid that countries might or companies might keep their income for these countries deliberately low, and then they say, well, we'll simply look at your group ratio, and then we'll apply 30% of your group profitability ratio to the income that you earned in our country. And now what happens then if the taxpayer says, sorry, but we can't get that information? Then the text is very simple, where the segmental profitability ratio is not available to the contracting state, the provisions of paragraph 2 shall apply. So if you do want to be taxed on net income, you do have to be able to show what the group profitability ratio is, and also the local profitability ratio. And if you can't do that, then you do not have the option of being taxed on your net income. Now, some countries felt that that this income might be too high, because if you compare Pillar 1 to this text here, Pillar 1 taxes 25% first of all, not the 30% as a marketing tangible, if you want to call it that, and more importantly, Pillar 1 also gives an exemption for the bottom 10%, saying those are routine profits and those need not to be taxed in the source state. They should be they are taxed in the resident state. And the UN says for countries that want to follow the similar approach, you can have an alternative wording to Article 12b(3). And as you can see, the text looks very much the same as it does in the standard wording. The provision of paragraph 2 shall not apply if the beneficial owner of the income, being a resident of the other country state, requests the other state to be taxed according to the laws of that state, right? But then it goes on to say, for the purpose of this paragraph, the qualified profits shall be X% of the amount resulting from the applying the gross annual revenue from automated digital services derived from the other contracting state where such income arises, deducted by Y% deemed return on routine functions. So countries could, for instance, agree that the qualified profits shall be 30%, but then you deduct 10% of that as routine functions, and you only tax the remaining 20%. And then next I want to have a look at the fees for technical services, fees for automated digital services, and then just the standard Article 12 dealing with royalties. And that's because the next paragraphs are pretty standard for Article 12, also for Article 11, and to some extent Article 10. So we'll deal with that in one group. And the first is the resident receives income through a PE in the other contracting state. And as we already know from the other model convention articles, that typically means that it is the PE state that can tax and not the resident state, right? So Article 12 for royalties says the provision of paragraph 1 and 2, which is that the resident can tax but the source state can tax also, shall not apply if the beneficial owner carries on business through a permanent establishment in the other state. In such cases, the provisions of Article 7 or 14, 14 being fixed base in the UN, shall apply. In other words, if you are resident state A, you have a PE in state B, and the PE generate royalty income, then it is the PE state that can tax that royalty income, right? And you can see the same for Article 12A and 12B. Interesting point is, if we look at the letters A and B in the text, A says where there is a permanent or a fixed base, and then B says business activities referred to in paragraph C of paragraph 1 of Article 7. And now what does Article 7 say? There's obviously allocation of profits, and it says the profits of an enterprise of a contracting state shall only be taxable in that state unless the enterprise carries on a business of the other contracting state through a permanent establishment situated therein. Then it can be taxed in the other state, but only so much of the profits as attributable to that permanent establishment. And this is what the OECD model says as well. But then the UN has a limited force of attraction rule, which is reflected in paragraphs B and C. But since B deals with goods and Article 12 concerns services, B does not apply. So then we look at C, and it says, you can also tax such profits to the extent that it's attributable to other business activities carried on in that other state of the same or a similar kind as those effected through the permanent establishment. So if you provide legal services through a PE and you happen to do some other legal work in that country, but it is not through the PE, it is similar work, and therefore that country will be able to tax that as well. And that applies for fees for technical services and automated digital services as well. I'm not quite sure how you would apply that to 12B, but I'm sure the commentaries will provide some examples of that. And then if we look at paragraph 5, now we talk about where does income arise, because the source state can tax the income where it arises, right? And if we look at Article 12 standard, it says royalty shall be deemed to arise in the contracting state when the payer is a resident of that state. Where, however, the person paying the royalties has a permanent establishment and such royalties are borne by such permanent establishment, then such royalties shall be deemed to arise in the state in which the permanent establishment is situated. So in the previous paragraph, we looked at the PE being the recipient of the royalty income. Here we are looking at the PE paying the royalty income, right? And then the same for technical services and automated digital services. If it is the PE paying, then it is deemed to arise in that state. And then there's something interesting, because if you look at paragraph 6 and 10 of Article 12A and 12B, there's no equivalent in Article 12, and I wonder why these have been added, because they are effectively covered by the first sentence of Article 12, paragraph 5, because paragraph 6 of 12A says, for the purpose of this article, fees for technical services shall be deemed not to arise in a contracting state if the payer is the resident of that state and carries on a business in the other state through a permanent establishment situated in that other state, or performs independent services through a fixed base in that other state, and such fees are borne by that permanent establishment. Why the UN didn't simply write fees for technical services shall be deemed to arise in a contract state where the payer of a resident of a state, where, however, the person paying the technical services has a PE, it applies to the PE. It's a little unclear, but anyway, both 12A and 12B have similar paragraphs. And then finally, we have the transfer pricing paragraph, just like we have in Article 11 as well. And if you look at the paragraph 6 in Article 12, it says, where by reason of a special relationship between the payer and the beneficial owner, the amount of royalties exceeds the amount that would have been agreed in the absence of such relationship, the provision of this article shall apply only to the last mentioned amount, right? So in other words, you can only apply the withholding taxes, for instance, under Article 12B2 and 12A2 and then 12B3 to the arm's length amount. And then this last sentence then says, in such case, the excess part of the payment shall remain taxable according to the laws of each contracting state, due regard being had to the other provisions of this convention. So if the other state says, well, the excess payment is treated as a dividend, and now we're going to levy a dividend withholding tax, then it would need to look at Article 10 and apply the limitations on the dividend withholding tax article in levying that withholding tax. This was it for Article 12B, A and B. that I want to discuss. It's very high level, but I think it's useful just to be aware of that, and also to see what the similarities and the differences are with Article 12 and with each other. Will Article 12b survive and be applied in treaties? I don't know. I mean, we expect that that Pillar 1 and the requirement to remove all digital services taxes would limit Article 12b, but then again, not everyone might sign up for the full Pillar 1, and in that case, maybe 12b would come into their treaties. I look forward to discussing case law with you again next time.